This is the craziest thing I've seen in finance. Silver just crashed 35%. Everyone's panicking. But the same bears who predicted the crash are now saying buy, and they're targeting $200. Here's the evidence they just leaked. They just obliterated silver. A 35% intraday massacre. The worst single-day carnage since 1921. Over $196 trillion in market cap vaporized in 36 hours. Gold down 13.6%, wiping out $5 trillion. The financial media is screaming collapse. Traders are liquidated. Panic is everywhere. But here's what nobody is telling you. The very same analysts who called this crash are now quietly flipping bullish. Not in 6 months. Not after some recovery. Right now, at $80. And they're targeting $200. Why? Because what just happened wasn't a breakdown. It was a setup. And if you understand what's actually occurring beneath the surface, you're witnessing the greatest buying opportunity in precious metals history. If you want unfiltered truth over mainstream propaganda, smash that like button, share this with someone who needs to see it, and let's expose what Wall Street doesn't want you to know. I'm Asian Guy, and this is the analysis they tried to bury. Let's start with the numbers that make absolutely no sense. Silver dropped 35% intraday. That's the largest single-day drawdown in recorded history. $80 to $85 range completely annihilated. Gold fell 13.6% below $4,900. Platinum down 27.25%. Palladium down 21.5%. Combined, over $7 trillion erased from precious metals alone. Add in the simultaneous stock market crash, and you're looking at over $10 trillion destroyed in 48 hours. That's more than the entire annual GDP of every country on Earth except the United States and China. To put that in perspective, that's 2.5 times the UK's entire economy, double Germany's, double Japan's, double India's. Gone. In 2 days. The headlines are calling it the red candle of death. The technical breakdown that proves the precious metals bull market is finished. Retail investors got slaughtered. Leveraged traders wiped out. Margin calls everywhere. Forced liquidations cascading through the system. But here's where it gets weird. Really weird. While COMEX was imploding, while Western traders were panic selling, while margin clerks were liquidating positions left and right, Shanghai spot silver was trading at $122 per ounce. COMEX closed at $85. That's a $37 premium, a 43.5% markup. Let me say that again so it sinks in. Physical silver in China is trading 43% above the paper price. In New York, after a 30% crash, the premium didn't compress. It didn't disappear. It didn't normalize like it's supposed to during liquidations. It's still massive. In fact, it's widening. In normal markets, when prices crash, premiums evaporate. Physical sellers panic. They flood the market. Premiums go to zero or even negative, but not this time. Shanghai buyers are paying nearly 50% more than COMEX traders. That's not a market. That's a war. Now let's talk about what happened on first notice day for February silver contracts, because this is where the story gets absolutely insane. 9.4 million ounces of silver delivery notices were issued, 1,881 contracts on the first day. And this was before Friday's 20% smash, before the crash, before the panic. Delivery demand was already surging. Let me break down who was scrambling for metal. Wells Fargo issued 701 delivery notices. JP Morgan issued 395 and stopped 487. Macquarie issued 459 and stopped 533. These aren't small players. These are the biggest banks in the world. And they're issuing notices, stopping notices, moving metal around frantically like they're playing musical chairs, and the music is about to stop. Connect the dots with me. If the fundamentals were broken, if physical demand was collapsing, if this was a real supply-driven crash, why would delivery notices be exploding? Why would the banks be scrambling for physical metal? Why would Shanghai be holding a $37 premium? The answer is simple. This wasn't a fundamental breakdown. This was a paper manipulation. And the physical market is screaming that loud and clear. Here's what actually happened. And once you understand this, the entire crash makes perfect sense. The physical silver market was tightening into a squeeze. Delivery demand was exploding. COMEX inventories were draining. Shanghai premiums were widening to unsustainable levels. The system was on the verge of a delivery crisis that would expose the fraud. So they panicked. And they unleashed the most obvious manipulation in market history. Massive coordinated short selling on the paper futures markets. No new physical ounces were created. No mines suddenly ramped production. No industrial users stopped buying. The fundamentals didn't change at all. What changed was the paper price. And they crashed it violently to achieve three objectives: shake out weak hands, trigger margin calls and force liquidations, and reset positioning before the physical squeeze could accelerate into a systemic crisis. Think about the timing. 9.4 million ounces of delivery demand before the crash. That's physical buyers screaming, "We need metal now." Then suddenly, boom, A 35% intraday massacre. The worst day since 1921. Retail wiped out. Leveraged traders liquidated. And after all that carnage, the Shanghai Premium is still 30 cents forward. The physical market didn't panic. The physical buyers didn't disappear. Only the paper price collapsed. That divergence is the smoking gun. That's proof this was orchestrated manipulation, not organic price discovery. Now here's where it gets really interesting. The very same analysts who predicted this crash, who warned about the technical breakdown, who said $90 to $95 support would fail, they're now saying buy. Not eventually, not when it recovers, right now. At $80. Why? Because they understand what just happened. They see the delivery data, they see the Shanghai Premium, they see the bank scrambling. They know that when you get a 35% crash with fundamentals this strong, with physical demand this intense, with premiums this wide, you don't get a prolonged bear market. You get a violent snapback rebound that takes out the highs and makes new records. The target? $200. And here's why that number isn't crazy. Silver's all-time high from 2011 was $49. Adjusted for real inflation using honest measures, not the manipulated CPI, that's $70 to $80 in today's dollars. We just hit $80, so we're barely at the inflation-adjusted previous high. We haven't even broken out yet in real terms. But the supply-demand fundamentals today are infinitely tighter than 2011. Global industrial demand in 2011, around 480 million ounces. Today, over 580 million ounces and growing. Solar, EVs, 5G, AI data centers, defense electronics. Silver consumption is exploding. Meanwhile, mine supply peaked and is declining. Above-ground inventories are being drained. COMEX registered silver has been falling for months, and now we're seeing record delivery demand with 9.4 million ounces in one day. The physical shortage is real. The crash just made it worse by scaring away marginal supply. And here's the catalyst that could be the trigger for the rebound. Polymarket is pricing an 85% probability of a U.S. government shutdown by January 31st. That's tomorrow. 85% odds. If you remember the 2025 shutdown, you know what this means. 43 days. 2.8% GDP hit. $34 billion in economic damage. 670,000 federal workers sent home without paychecks. Contracts delayed. Approvals delayed. Data delayed. Economic activity grinding to a halt. Democrats are weaponizing the Minneapolis Border Patrol shooting to block the DHS funding bill. If DHS funding stalls, you get a partial shutdown that could spiral into a full shutdown. And markets are not pricing this at all. The typical market reaction to shutdowns follows a pattern. First phase, risk-off panic. Liquidations, flight to cash. Everything sells, including gold and silver, as traders scramble for liquidity and margin calls hit. Second phase, safe haven flows return. Fed is forced to signal easing. Precious metals rip higher as the dollar weakens and uncertainty spikes. We just saw phase one, the 35% crash, the liquidation, the panic. Phase two is coming. And when it hits, with physical demand this strong and inventories this tight, the move could be historic. Let me lay out the bull case as clearly as possible. We have the worst single-day crash since 1921, but we also have 9 straight months of gains. Silver closed January up 19% despite the crash. That's 9 consecutive green months. The trend is still up. We have record delivery demand, 9.4 million ounces on first notice day before the crash. Banks scrambling for physical. That doesn't happen in a bear market. We have a 43% Shanghai premium after a 30% crash. That doesn't happen when fundamentals are broken. Premiums compress in real crashes. This one is holding and widening. We have structural supply deficits. The Silver Institute projects deficits continuing through the end of the decade. Industrial demand growing, mine supply flat to declining, above-ground inventories draining. We have central banks buying gold at record pace, validating the monetary metals thesis, and silver follows gold, but with industrial demand layered on top. We have a potential government shutdown tomorrow that could force Fed easing and spike safe haven demand. We have COMEX margin hikes to $52,000 per contract, which is a sign of stress, not strength. They're trying to choke off leverage because they can't deliver the physical. And we have bearish analysts who predicted this crash now flipping bullish and targeting $200. They're not saying maybe. They're not saying if conditions improve. They're saying the setup is here right now at $80. Now let me be clear about the risks, because I'm not here to pump opium. A 35% crash in 36 hours is not a joke. If you were trading on leverage, you got destroyed. If you had tight stops, you got stopped out. If you were overpositioned, you're underwater. The technical damage is severe. The red candle of death is a real breakdown pattern on the charts. And if the government shutdown actually happens and drags on like 2025, the initial phase could keep pressure on risk assets. Everything could sell further as liquidity dries up and margin calls cascade. The paper market can stay irrational and suppressed longer than most traders can stay solvent. There's no guarantee the bottom is in. We could see more pain before the turn. If you're trading this on margin, this environment is a meat grinder. Even if the long-term thesis is correct, the short-term volatility can wipe you out before the rebound comes. But here's the difference between paper traders and physical stackers. Physical stackers don't care about the daily noise. They see a 35% crash as a gift. A sale. A chance to accumulate more real metal at manipulated prices before the paper system breaks. They understand that the Shanghai premium holding at 37 means the physical market is not following the paper market down. They understand that 9.4 million ounces of delivery demand means the squeeze is real. They understand that when banks are scrambling for metal while the price is crashing, something is very wrong with the pricing mechanism. So here's where we are. 3 key takeaways. Number 1, silver just posted the worst day since 1921. 35% intraday crash. $1.96 trillion wiped out. But 9.4 million ounces of delivery notices were issued before the crash. Wells Fargo, JP Morgan, Macquarie scrambling for physical. That divergence between paper and physical is the story. The crash was manipulation, not fundamentals. Number 2, Shanghai premium is $37, 43% above COMEX after a 30% crash. In normal markets, premiums disappear during liquidations. This time, it's holding. Physical buyers in China are paying nearly 50% more than paper traders in New York. And silver still closed the month up 19%, marking 9 straight months of gains. The bull market is not broken. The paper market is. Number 3, bearish analysts who called the crash are now flipping bullish with $200 targets. They see the delivery data. They see the premiums. They see the setup. Combined with an 85% chance of government shutdown tomorrow, which could force Fed easing and spike safe haven demand, the rebound could be violent. The risk reward at $80 with physical this tight is asymmetric to the upside. The unresolved tension is this. We just witnessed the worst silver crash in 103 years. But delivery demand is surging, premiums are holding, and banks are scrambling for physical. Does the paper market crash further and take us below $80, or does the physical reality reassert itself and force a snapback that takes us to $150, $200 or higher? And with an 85% probability of government shutdown hitting tomorrow, how does that catalyst play into the next move? Does it trigger another liquidation wave? Or does it become the excuse for Fed intervention that sparks the safe haven rally? $7 trillion erased. Worst day since 1921. Red candle of death. Everyone sees weakness. But 9.4 million ounces of delivery demand, $37 Shanghai premium, and bearish analysts, flipping bullish, tell a different story. They panicked. They unleashed the most obvious manipulation in market history, and the physical market is screaming that they're fighting for survival. Do your own due diligence. Understand the risks. If you're trading on leverage, this volatility is a liquidation machine. 35% crashes wipe out over-leveraged positions instantly. But if you understand what's actually happening, physical demand surging, premiums holding, banks scrambling, bearish analysts now saying buy, then you know this crash is not about fundamentals. It's about desperation. It's about a paper system trying to survive one more day while the physical market tightens into a squeeze they can't escape. The move from $80 to $200 nobody sees coming. It's already being built, right now, in real time, while everyone is panicking. The question is, are you going to be the one who saw it coming, or the one who got shaken out at the bottom? This is Asian Guy. The crash was the setup. The rebound is coming. Don't let them steal your metal at the bottom. Invest with logic, not hype. I'll see you in the next one.